Hello and welcome to XM's educational series Ask the Expert. In this video we're going to explain two very popular trading terms, risk on and risk off. If you're a trader, you've probably come across these phrases already, but may not be entirely sure what we mean by them. So let's take a closer look to understand what they are. Risk on and risk off are market behavior terms used for gauging investor sentiment. They can either describe a particular trading environment or the general mood of investors. Risk on sentiment is often characterized by investors feeling optimistic about the outlook and are therefore willing to take on more risk. To put it slightly differently, investors have appetite for risk, hence where the identical term risk appetite is derived from. So what brings about risk appetite? Well, it can be anything that prompts investors to change their outlook on the economy to a more positive one. This can include upbeat economic data, or it can be the central bank announcing looser monetary policy, for example, by cutting interest rates. Or it can even be an easing of a crisis such as a political crisis that was previously seen as posing a threat to economic growth. Now, what about risk-off sentiment? Well, as you've guessed, this is the opposite of risk on, and this occurs when investors start to feel more pessimistic about the outlook. During risk-off trading sessions, investors become more risk-averse, and this leads to reduced appetite for risky assets. There are a number of factors that can generate risk aversion. Gloomy economic data, especially data signaling a recession, is one of them. A major crisis like a banking or energy crisis is another. But what investors fear most is tighter monetary policy. In general, anything that suggests central banks like the Fed will need to raise interest rates, whether it's an explicit signal from policymakers or data pointing to simmering inflation, tends to spark a sell-off in riskier assets and the flight to safety. And this takes us to the next part, which is what currencies and assets move the most during risk-on, risk-off episodes. At times of positive risk sentiment, traders prefer high-yielding assets like equities or growth-sensitive currencies like the Australian dollar. However, when there is negative risk sentiment, it is low-yielding but safe assets like government bonds and precious metals, most famously gold, that attract the most demand. Whereas amongst the major currencies, the US dollar, Japanese yen and Swiss franc are considered to be safer options during times of uncertainty. I hope you found this video useful. If you enjoyed watching it, please click on the like button, and if you have any questions you would like us to answer, you can also email us at asktheexpert@xm.com.